All right, let's talk about something huge that just happened. U.S. regulators made a decision that's basically given a massive green light to the future of finance. So we're going to break down what this major shift is all about.
Okay, so let's just start with a simple question that really gets to the heart of the matter. Have you ever stopped to think about how weird it is that in our super fast, digital world, sending a funny cat picture across the planet is instant, but moving serious money can be painfully slow? And this is where that disconnect really hits you. We can send an email, a file, pretty much any kind of information, anywhere in a blink of an eye. But when you're talking about financial assets, stocks, bonds, that kind of stuff, the whole process can take days to officially go through. It's got to pass through this whole complicated web of middlemen.
Now that delay, that friction, it's not just an inconvenience. It actually creates real costs, adds risk, and just makes the whole system inefficient. It's a problem that a lot of smart people have been trying to fix for years with some really cool new tech.
And that high-tech solution is something called tokenization. Just think of it as a massive upgrade for the financial world's plumbing, trying to get it up to the speed we expect from everything else in our digital lives.
So, what on earth are we talking about when we say tokenization? Well, put simply, it's about creating a super secure digital version of a real-world thing, like a share of stock or a piece of property, and putting it on a blockchain. It's basically a digital deed or a certificate of ownership that's really tough to tamper with and super easy to trade. Here's how it would work in practice. Let's say you've got a big commercial building. First, you get it officially valued. Then, you could divide the ownership of that building into, say 1,000 little digital pieces or tokens. Then you issue those tokens on a blockchain, and boom, people can buy and sell fractions of a building almost instantly. And this is where it gets really, really interesting. The potential benefits are just massive. We're not talking about a tiny little improvement. This could make things like real estate way easier to buy and sell. It offers incredible transparency because every transaction is recorded, and it could slash costs by cutting out a lot of the manual work and middlemen. Okay, so if this technology is so great, with all these amazing benefits, you're probably asking yourself a pretty logical question right now.
Right? What's the catch? And for a long time, the answer came down to one single massive roadblock: uncertainty. And that's something that big, heavily regulated institutions absolutely hate.
You see, the big banks, the investment firms, they couldn't just dive headfirst into this stuff because there were no clear rules. The rulebook was basically blank. And without knowing how regulators would view these new digital assets, the risk of getting into serious trouble was just way too high. It stopped innovation dead in its tracks. And this quote from John Smith, a strategist in this space, really nails it. The big players wanted that green light, but they also knew it wasn't going to be a free-for-all. It's like they were asking for a clear set of rules for a brand new game.
Well, on March 6, 2026, that all changed. That huge regulatory roadblock, it was finally cleared thanks to a landmark announcement from U.S. regulators.
So, regulators like the Federal Reserve came out with this game-changing clarification. And the whole thing boils down to these three little words: same capital rules. Now that might not sound like much, but for the financial world, it's an earthquake. So what does capital treatment even mean? I know it sounds like boring bank speak, but stick with me because it's actually pretty simple. Basically, banks have to keep a certain amount of cash on hand, like a rainy day fund, for every asset they own. The riskier the asset, the bigger the rainy day fund has to be. And this slide shows you why that matters so much. Before this new rule, a bank might look at a tokenized bond and have to treat it like some weird, super risky crypto asset. That meant they'd have to lock away a ton of money for their rainy day fund, making it not worth it. But now regulators are saying, nope, a tokenized bond is just a bond. You treat it based on the risk of the actual bond, not the tech. That makes it totally viable. And I love how Dr. Emily Chen puts it. This finally gives these big institutions the confidence to move forward. The conversation is officially over about if this is going to happen. Now the conversation is all about how we build it and how fast. So the green light is on, the engine is running. What does this new world actually look like? What does this ruling unlock starting like right now? Well, for all the financial firms out there, this is basically the starting gun going off. They now have a clear path to go ahead and invest in the tech, build up their security, and, this is the exciting part, start creating totally new things, like tokenized funds or other cool products for their customers. Now, of course, this isn't a magic wand. It's not like every single challenge is solved overnight. As experts point out, there are still some tricky details to iron out, like exactly how legal ownership works and how these things will be treated across different countries.
But make no mistake, the fundamental direction has been set. The green light is on. We're going to see digital assets become a core part of mainstream finance, which leaves us with one final thought. The rulebook has officially changed. The only question now is, how fast can the financial world learn to play this new game?